Hi, everyone. Thanks for joining us today. In just a moment, Fuel Freedom co-founder Eyal Aronoff will be speaking on oil prices, oil future, and speculation. Eyal is the co-founder of Quest Software, one of the largest independent software ventures in the world. He also spent over a decade analyzing the economic and geopolitical impacts of America's dependence on oil, leading him to found the nonpartisan Fuel Freedom Foundation, which is dedicated to open up the markets to cheaper, cleaner replacement fuels. After Eyal's presentation, there will be a question and answer period. If you have any questions you'd like to ask, please type them into the Q&A box that is on the right-hand side of your screen. We will answer as many questions as possible in the allotted 1-hour period. Thank you for joining us today, and now I will pass it on to Eyal Aronoff.
Good morning, everybody. Thank you for joining our webinar today. We are going to explore a topic that has been baffling many of us consumers, which is how is the price of oil set in the market? I just found that quote the other day by Raymond Dorsey in the Huffington Post, and it seems that the oil market has now moved away from fundamentals. And just read it for you. The U.S. commercial crude oil inventories near all-time highs. U.S. oil increasing by some million barrels a day from a year ago, with weekly inventories of gasoline jumping by 800,000 barrels equivalent last week alone. While Chinese demand is flat or down, yet the price of oil has jumped some 9.5% since June. Okay? This, while virtually all basic commodities have gone down in price significantly. So the question we have is, how is the price of oil set and who are the players? This topic, of course, is complicated and convoluted. So I have done my best to simplify it. However, I am going to touch the players in this market and the relationship between them and the contribution factors that gets us to where we are today. So first, let's talk in general terms. What is the market of oil, the market of crude? So when we say the market controls the price of oil, have you ever asked yourself who are the players in this market? Who controls the price of oil? So let's think about it this way. Who is selling oil? Well, the integrated oil companies produce the oil and they offer it to sell. Who is buying oil? The integrated oil companies that also own refineries buy the oil to refine it to make oil products like petroleum and diesel fuels and so on. Of course, this is a great simplification. Okay, however, one can understand that the players in this market, unlike, say the equity market where people buy shares, it could be individuals, can be investment funds, can be different people buy shares. Here, the people that buy and sell the contracts in the commodity markets are really have the same interest in mind. And what is that interest? The interest is to maintain high prices and price stability. And when we say maintain high prices, really what we mean is that we maintain high prices relative to production costs. Okay, so the oil companies want to ensure that the price of oil is high enough relative to their production costs. And they have an incentive to ensure price stability because they make very long-term investments and very large amounts of money. And so price stability is an important currency for them. However, as I wrote here, right here the market is rigged because the interest of the oil companies really is the thing that determines the price of the commodity in the market. However, the oil companies are not the only players. any market that is very stable, that have very defined interests, okay, is very good for financial institutions to invest in. As a result, is today the market of oil, the exchange, is dominated by financial interest. Again, the financial institutions do not particularly have the consumer in mind. Then beyond the oil companies and the financial institutions, the largest players in the market are the sovereign oil companies. The sovereign oil companies, which hold today, I think, something like 80% of the world oil reserves, have incredible capacity to change the characteristics of the market over a short period of time. And if that was not enough, then there is the commodity exchange itself. The commodity exchange is owned by a company called the CME Group, which is a publicly traded company. The CME Group also have its own interests. So although the exchange is supposed to be completely benign, because this company reports profits and earnings, it has a certain interest which we are going to explore today. So now let's try to figure out how all those interests combine into the market we are seeing. So let me give you a short primer. We are really talking about two separate yet connected markets. On the one hand is what we call the physical market, which is the market of oil that actually exchanges hands. Okay, so these are oil companies that produces oil, and they are selling the oil to refineries that refine the oil. So most of the physical oil in the physical market is traded on long-term contracts, which means, so for example, if I'm an oil producer, I may have an arrangement, a pre-agreed arrangement with some refineries to buy all my oil. Okay, my oil is not available for bidding in the physical market, in the exchange. So only a small portion of oil is available for bidding in the exchange. On top of the physical market, we have the futures market, or also known in the industry as the paper market, which is a contract to buy. Okay, the future is a contract to buy. It was created to enable producers and consumers of oil to hedge their exposure to the oil price. So if I'm an airline and the price of oil is now relatively low, say because there was some event and the price went down, then I can buy oil futures to help me protect against increase in the price of oil. So I have to pay premium for this contract, but it guarantees the price for me into the future. In theory, only a small portion of the actual oil market supposed to be, the future market supposed to be smaller than the actual oil market, because the players in the market only need to hedge a portion of their position. The relationship between these two markets is built on something called chance of delivery. So when the price of the future, the reason the price of the future converges with the price of oil in the physical market is because in expiration, when the contract finally expires, there is a chance of delivery. And what this means is if you hold your contract for this oil until expiration, you were supposed to receive delivery of 1,000 barrels of oil for every contract you held. Okay, so it was built this way to enable the physical market to set the price for the future markets. But in principle, the future market should not be able to set the price for the physical market. So that's the mechanisms. When the CME went public in the end of 2002, the CME, which owns the exchange itself, they make money on transactions. When somebody buys and sells oil contracts, they get a commission. So they were set up to increase the volume of contracts and options traded in the main energy commodities, which are the most liquid commodities. They achieve this by replacing the trading pit with an electronic trading system. Okay, so what an electronic trading system is people can write commands on the computer that will enable them to buy and sell the commodity, which gives the financial institutions big leg up into this market. Okay. So before the market was really built to support the needs of the oil companies selling oil internally to themselves, with the introduction of electronic trading, it opened the door for more and more financial institutions to come and play in the market. As a result, the future market is now 30 times larger than the physical market. And as a matter of fact, every day, more future contracts exchange hands than a full month of consumption of oil in the United States. Okay, let me say this again. More contracts exchange hands every day than the full consumption of oil in the United States in a month, or a full consumption of oil in the world in a week. Then on top of that, you can financially settle your contracts, which means that you never get assigned to oil. And that essentially erodes the fundamental behind the market. Okay, so as you're seeing here, what's going on is that the interest in the market diverged, and with it, the fundamentals in the market have diverged. So let's follow what happened after that. The first few years of electronic trading, the market was in something called Contango. Contango means that the current price of oil in the physical market is cheaper than the future price of oil in the futures market. So let's assume that the current price of oil is, say, $107. But oil for delivery in, say, September is $110. So I can buy oil today in the physical market and store it at $107, and at the same time I can sell the contract for somebody to buy the oil for me tomorrow at $110 and make around 3% profit. This is guaranteed profit because it's the price is already set before you even got going. So it was worthwhile for the longest time to buy and hold oil today and sell future contracts against it for a guaranteed profit. And that was a perfect backdrop for investment opportunity for big financial players that could put big money to buy and hold the oil. So what we've seen is more and more financial institutions start to acquire storage capacity to hold physical oil. Now, financial organizations are not particularly equipped to run and manage storage capacity. So the CME, in order to help them, introduced systems by which you can trade and you can do clearing. It's called electronic clearing, that you can clear delivery of oil electronically. So in effect, you can receive delivery of oil virtually without actually receiving the oil. Okay. So now the stage is set. Anybody, sitting in a tent in Pakistan can open a bank account in one of those big brokerages, say New Age. Deposit, say, $50 million there, and start acquiring oil in the physical market and drive up the price of oil. And the only thing you need is a computer. Now let's go back to the fundamentals and see how the machine actually works, how you pump up the profit. So as we said already, most oil in the physical market is already committed. Okay, therefore, it's enough to bid up a small amount of oil for delivery in order to increase the price of all oil. And when you increase the price of all oil, you also increase the price of all future contracts. Okay, so let's say that the price of oil is currently at $100 a barrel. And let's say that I agree to receive delivery of $10 million worth of oil for $101 a barrel. That may be enough to increase the price of all oil to $101, which is a $1 increase for 1.5 million corresponding oil future contracts, okay, generating $1.5 billion increase in value because every contract is 1,000 barrels. Okay, let me repeat this. It's enough to bid up the price of small amount of oil in the physical market to drive up the price of all oil. And since the futures market is that much bigger than the physical market, it drives up the price of all those contracts that are dependent on the physical market. So in the end, it's a highly, highly leveraged game. So who pays the price? Okay. You only need to put between $4 to $6 a barrel, called the minimum margin requirements, to buy a future contract for oil, okay, which multiply the effect of your dollar by 16-fold. So with few tens of millions of dollars, the institution can buy and then change the investment portfolio, the investment value of its portfolio worth billions of dollars. Right? So if I want to buy $1 billion worth of oil, I only need to put about $60 million worth of futures, and then I can spend another $10 or $20 million to drive up the price of oil by $1, and it will make $1 billion worth of profit. I mean, all of this stuff is in theory, but you get the point. Now, when they make $1 billion worth of profit in the futures market, it means tens of billions of cost to consumers. Okay, this is a really important thing to notice about this particular market. The oil exchange has direct impact on every person that uses transportation in the world. So although these games between financial institutions and oil companies, all these games are in order to, we call scalping, to harvest profits in the market, the implication on the consumers are gigantic. So as this makes you sick, you should think about the fact that this is the games that the small fries in these markets are playing. The big fish, okay, are the big oil producers. And chief among the big fish, of course, are the Saudis. So the Saudis are, in effect, play the role of a central banker in the oil market. If the price goes too high to Saudis' liking, they can release oil into the physical market, enough to overwhelm the hoarding trade. And if the price is too low to their liking, they cut supply to stimulate hoarding. However, the big fish, the nature of their intervention is short-lived. And why is it short-lived? Because once they act in the market, the biggest advantage is the surprise of the actual act. But once they act into the market, they get priced in, and that effect is muted. Okay, now here, let me leave you with this question. So nobody really knows if the big fish and their sovereign wealth fund also bid in the market. If they did, this could be a way for them to make huge amounts of money without depleting the oil. Let me give you an example. Let's assume that I'm a sovereign wealth fund, say, of the Saudis or Kuwait. I can buy a whole bunch of oil futures contracts, and I can do it without anybody knowing by opening an account in one of those companies that I told you. Then I can announce all of a sudden cutting the production. And really, they don't really need to actually cut the pumping. What they need to do is cut the delivery of oil to the physical market. That will drive the price up, and sometimes only the announcement actually drives the price up. They don't need to actually even withhold the oil. Then what you do is you flip the position to short, and you release all this inventory, and again, overwhelming the holders, and the price drops. Okay, all of this sounds pretty illegal, huh? Inside trading, inside games, all this stuff. I mean, in the equity market, nobody would actually allow anything like this to happen. But it's not illegal. Actually, it is built exactly that way. And, you know, as I said before, the CME Group is a publicly traded company. So its interest and the interest of its shareholders is to maximize the amount of volume in the exchange. Now, since the physical market is limited by the actual availability of oil, actual oil traded, CME growth was capped. CME could not grow more than the size of the market. So what they did is they resorted to financial engineer, and they engineered this gigantic commodity market with commodity indices, with a variety of products, with options, with volatility indicators, all these other things to create more and more action, traffic, and trade in the commodity market. And of course, the best interest of the exchange really is not the best interest of the consumer. Okay, and it's not the best interest, may not be the best interest of the oil companies themselves, which they want stable pricing and a decent profit margin. And if you don't believe me, this is off the CME own website. And I actually have this little link in the bottom. This is how they advertise to attract people to trade commodities. More choices, more volume, more benefit for energy traders. The world's most liquid benchmark oil futures contract. The ability to trade anywhere 23 hours a day on CME Globex, which we talked about the tent in Pakistan. Anonymity and price transparency for all market participants. Okay, anonymity. Physically delivered and financially settled future markets, and right there they even say to you that there is really no relationship between the actual price and what is being settled, because you don't have to settle physically. And if you want to manipulate the price, you can actually settle it and get delivered this product. Okay, so all of this stuff is all the moving parts in this market. I mean, it's not all the moving parts. It's a simplified version of the moving parts in this market. So the question is, what is the real risk? How about that? How about the risk of being able to determine who is the US president? Or, in other words, replacing the president of the US. Now, okay, walk me through this a little bit. I mean, I'm going to walk you through this, and just you have to suspend your disbelief for a second, okay? This is a dramatization. So it is well documented that within 6 months of a significant increase in gasoline price, the US economy runs into trouble. As a matter of fact, every recession in the US preceded by a big spike in gasoline price since the 70s. It is also well documented that most presidents lose re-election when the US economy goes into recession. So think about it this way. Let's assume I wanted to buy a president of the US. So instead of spending billions on political contribution, why not spend a few tens of millions to beat up the price of gasoline? If I beat up the price of gasoline, say by $1, roughly 6 to 7 months before the election, I can almost for sure trigger a recession. Well, that's true unless the Saudis decide that they kind of like the current president and they overwhelm my trade. Sounds like a fiction, doesn't it? So let's look at the 2012 election cycle. Really makes you go, Prices were rising in the end, in the beginning of 2012, and we got to the point that oil was at $120 a barrel. And the government started, there was discussion all of a sudden of a double depreciation. The government was very worried about basically the state of the economy. So who drove these prices up there? Okay. Well, we don't really know, but what we do know is that Secretary Clinton went to visit Saudi Arabia in March of 2012. Nothing was announced after her return. However, about a month later, 3 weeks later, the Saudis all of a sudden declared a big increase in oil production. In the beginning, this didn't really make a big difference because we saw this gap between, as you can see, the price of gasoline really tracks the price of Brent, which is the international price of oil, not so much the price of oil in the United States, which is a topic for a whole nother webinar, which is the fact that we, the consumer in the United States, don't get the value, the benefit that our oil is cheaper than the international oil. Okay, so gasoline tracks the international price of oil, and all of a sudden you see a gap that gasoline spiked above the international price of oil. This is a sign of speculation. Now, the gasoline market is much smaller than the market for oil, and it's more regional. So you need less money to manipulate it. But as the Saudis keep pumping more and more and more, eventually they overwhelm that trade. Okay? And then again, we see right before the election a last-ditch effort to raise the price of gasoline in the market. Now we know the outcome. This didn't really work. But what happened if the Saudis would not all of a sudden release all this oil? Another thing we have to think about is what did Secretary Clinton promise the Saudis in order for them to release this oil? I mean, things we will never know. Okay, so, we are in the pickle. Right? All these big interests are impacting our day-to-day life and the livelihood of our economy. And really, nobody asks us about this. This just happens, and we can't really impact it. So the question is there a way out? So the Fuel Freedom Foundation, we believe there's definitely a way out. And the way out is to reduce the price of oil by overwhelming this system with low-cost fuel producers from a variety of feedstocks. Okay, so the idea is that if you bring enough fuels made from different feedstocks into the market, you overwhelm the capacity of the hoarders to hoard, of the big players, the big fish and the small fish. You overwhelm all of that stuff. Now, we believe in plurality of feedstocks, but I want to talk right now just about natural gas. In the United States, we have approximately 5 times more natural gas reserves than oil reserves. If we use natural gas as feedstocks, you can produce different type of fuels. Okay, so just like you use petroleum to produce gasoline and diesel and aviation fuels and other different type of fuels, we believe that you can produce these similar fuels from natural gas, like CNG, which is compressed natural gas, which could be used for local trucks, LNG, which will probably be used for long haulers and marine, and methanol, which we believe will be able to use for light-duty trucks, light-duty vehicles, and maybe other drop-in fuels like dimethyl ethers and others. The low production cost means drilling, and the simple processing, so you don't need a refinery. It means that the production cost and the supply chain for natural gas is going to be much more competitive than the supply chain and production cost of gasoline, which means that it will have a much bigger advantage at the pump. And then once natural gas based fuels open the market, other fuels made from other feedstocks, such as agricultural byproducts, trash, and so on, will be able to also come in. And all of that means is that in the end, many companies will be able to make very good margins competing with oil, which will erode the oil pricing power and will beat that game. Now we're going to open the phone for questions. Okay, so we have questions here. Okay, so the first question is, what makes you believe that that once it seems that the issue with oil comes from the fact that the market is determining the price for us, and what makes me believe that by moving to these replacement fuels, we are not going to have the exact same issues? And one of the things that I've talked about in the beginning is the fact that the interest of the oil companies is to keep up the price of oil above their production costs. And what we've been seeing is that the production cost is escalating in the last decade. Okay, I just kind of did a search just now, and I looked at to find out what would it take to get, say, be a trucker in Canada in the oil sands. So I'm looking here at these job descriptions, and I'm just now searching online. Okay, so utility operator, basal operation, Horizon Oil Sands, and this is what they're offering for the person. Competitive salary. This is for truck driver. Okay, competitive salary, which means 6-digit salaries. Stock options, stock savings plan, annual bonuses, benefits, location premium, relocation, fly-in and fly-out accommodation program in Alberta, Canada. Now, I remember the day we gave stock options to secretaries in the tech in Boom. Okay, so these days were called irrational exuberance. Now we're giving stock options to truck drivers, the truck tar sands in Canada. Okay, so what I'm saying is that the whole cost structure of that industry is completely out of kilter. And once competition comes in, the cost structure will go down, and with it, I believe, the prices. So the question is, how does the future contract price goes up because someone bids up the price of oil from $100 to $101? Aren't they set when the contract is purchased? Is the future contracts that have not been sold will go up? Okay, so contracts are created and destroyed by mutual agreement of the parties. But if the price of oil is rising, and I hold, let's assume that I bought, say, 100 contracts. Now I have the right to receive 100,000 barrels of oil. And let's assume that I bought it at 100. Now I start to buy oil in the physical market for delivery. Okay, and I'm buying and buying. So the price is rising, and my contract, say, expires by the end of August. So if I can keep buying until the end of August, the price would rise, say, to $101, $102. Those contracts would expire in the money. And when the contracts expire in the money, of course, I will elect at that point to settle them in cash, which will be the profit that I said. So yes, when you buy a contract, the price is set ahead of time. If by the end of the contract, the price is higher, when the contract expires, the price of oil is higher, and you choose to financially settle, you get the difference between the price you bought it at and the price that the contract expired. Next question. Fundamental erosion is the same as we in US went off gold standard. Is fundamentals erosion the same as when the US went off gold standard? That's also a fantastic question. For the longest time, it appeared as if oil and gold have been tracking in tandem. But over the last few months, it was shown that this is just because they are both proxy for the weakness of the dollar. So when the dollar becomes weaker, both oil and gold become stronger. And when the dollar becomes stronger, supposedly both become weaker. But what we've been seeing in the last few months is that this is not the case, that oil is still very expensive and becoming stronger, even though the dollar is becoming stronger while gold is collapsing. So I think that the explanation of this difference is not so much about the gold standard, but it's really the divergence between the relationship of oil, of commodities on oil, and gold with the dollar, basically. We've seen this divergence happen in the last few months. What is likelihood of this actually happening in the near future? So I am assuming that this means the fuel freedom agenda, which to me means opening the fuel market to competition for many different types of fuels. I think the chances are very good. Of course, that's why we are doing what we are doing. I think the chances are very good, and I think we have a kind of a once-in-a-lifetime opportunity here because of the shift that we have seen in energy in the United States. Okay, we have a very low-cost feedstock that can produce relatively a high amount of fuel. These fuels are very competitive with gasoline, and what it will enable to do is it will enable a whole new set of technologies to come to market, both on the car side, by the way, because these are high-octane fuels, and on the fuel production side. What are the barriers that must be overcome to make gas consumption more universal? I think there are three different barriers. The first barrier is the barriers in the mind of the producers of the natural gas. So natural gas, if you think about the oil industry came from a background of an integrated industry. And what does integrated industry mean? It means that the same oil company would explore for oil, would drill for oil, would pump the oil, refine it, deliver it, and even have the dispensing gas stations. So you have one integrated supply chain. In the natural gas world, that doesn't really happen. The natural gas producers usually sell their natural gas on long-term basis, a long-term contract to utilities. And that's how a lot of the financing is done in that world, which means if I have a patch that I want to drill for natural gas, I go to the local piping company midstream, or I go to the local utility and I say, hey, will you be willing to buy this natural gas for me at the price that we settle? And then if they say yes, which is called an uptake agreement, then you take this to the bank and you get financing to actually build the oil field, the natural gas field. And that was that. You were done. So the natural gas producers don't have this world view of end consumption in mind, which the oil producers did have, it being the integrated producers that they were. So I think this is the first barrier, is that the natural gas producers are still not in the same spot where the oil producers were, and I think this is an education to get them to be there. The second part is the cars. The cars we drive today can't really use these fuels unless we can modify them to use the fuels. So the car companies, as well as the aftermarket providers, need to be able to endorse this new phenomenon that we are going to have lower cost natural gas-based fuels and other biomass-based fuels for a very long time, and they should really wake up to that realization. And the third part is regulations. I mean, this is a highly regulated industry, and your car is regulated the minute it comes out of the production line, and there's very limited things you can do to your car without getting certified. So one of the big efforts of the foundation is to work within the existing regulatory framework to enable these changes to happen in the car. Okay, we have another question here. What is the difference between the equity market and the commodity market? Okay, well, it's a very good question. There is one gigantic difference between the equity market and the commodity market. The equity market is stock market. And the one fundamental difference is, I know that there's a bit bad rep for money managers, being around, they don't have a product and this and that, but really the equity market creates new wealth. So, when the market cap of a company is $10 billion, and then it goes to $20 billion, this $20 billion, this new $10 billion is divided across all the shareholders of the company. Nobody actually lost that $10 billion. Okay? It's new money created by the market, by the equity market. So it's a wealth creation mechanism. Of course, it can also be a wealth destruction mechanism if the stock price goes from 100 to 50. The commodity market is different. The commodity market regulates money transfer. It's a zero-sum game. Okay, so when oil price goes up from 50 to 100, what it means is that the oil consumer, us, the drivers, have to pay twice as much, and the oil producers can make twice as much. Not all of it goes to profit. The cost structure has been going up, as I said before, but it regulates money flow. It's a wealth transfer regulated system. So the equity market is a wealth creation system, and the commodity market is a wealth transfer system. One would think that the commodity market will have to be a lot more regulated than the in terms of insider trading and all that stuff, because it impacts us much more. But alas, it's not the case. It's exactly the opposite. Okay, next question. I hear that the U.S. is going to overtake the Saudis' oil production. Doesn't make us the big fish. Well, it's good that you mentioned this. Maybe I'm a little bit jumping the gun here. But I'm going to talk about exactly that in our next webinar. Yes, definitely it makes us the big fish, but still will not make us the price determining party in the market. Okay? It will make us the price determining in the market when the market becomes a combination of natural gas production and oil production. So today these two markets are not connected. In other words, they are not fungible. That's the professional term. These two markets are non-fungible. The pricing is determined separately because the use of the product is different and the competitive pressures in each of these markets are different. Natural gas today competes with coal and to some extent with nuclear in the energy generation space, in power generation, electricity, and petroleum basically competes with nothing in the transportation space. So by taking natural gas and enable it to become massively enable it to become a competitor in the transportation fuel space, then we make these two markets fungible, In other words, we unify these two markets, and now we sit on a potential that is 6 times bigger than the potential of just our oil production power. And that will really enable us, and the Russians, by the way, to become the price setters in the world, which will make us the big fish, yes. Once the oil interest takes steps to stop production of alternatives such as buying the natural gas fields. I think the notion, so this is, I think, we are now in the process of having transition in the United States. And this transition is from being an oil-focused production in the oil and gas world to a gas-focused production in the oil and gas world. In other words, the big oil companies may be international oil producers, but they are natural gas producers here locally, domestically. Okay, so as a result, again, go back to the fundamentals. At $4 an MCF, there's 5 times more natural gas in the United States than oil. At $6 an MCF, maybe 7 times. At $10 an MCF, maybe 10 times more natural gas than oil. So the profit opportunities for the oil companies in the natural gas world in the United States is much, much larger than in the oil world. So yes, they will buy natural gas, and they will use the natural gas to increase their profits. And the way to do it is by competing with a very expensive product, which is oil, not by competing with a very cheap product, which is coal. Next question. What can I do today, although I am not a big user of gasoline mileage, switch to CNG for my light truck car? Okay, so the question is, what can you do today? So yes, today you can switch to CNG, and more CNG filling stations are springing out there. Unfortunately, the cost of switching to CNG, particularly if you're not a heavy user, is not worth it. Okay, so 2 things need to happen. Either we enable your car to run. So the reason the cost is expensive is twofold. A, you need to put a whole new fueling infrastructure in your car because your car was built for liquid fuels, and you're going to put in a gaseous fuel. And B, the regulatory requirements are onerous, so its costs are very high to license the system. If you are an installer, you have to be a licensed installer, and so on. So the regulatory requirements are high, and the cost of the system is high. However, if we enable your car to run, say, on methanol, which is a liquid fuel created from natural gas, your car already is built to run in liquid fuel, so the changes you will need to make in the car is very minor. Today, there are no, products, companies that offer this as a service yet because the regulatory process have not kept up with this possibility. But we believe that this is going to happen very quickly, and this will be the solution to go forward for light-duty vehicles. Next question. How do you make liquid fuel from natural gas? The simplest, most way to do it is to convert natural gas, which is a single carbon molecule, okay, called methane, which its formula is CH4, to convert it to an alcohol, which is called methanol, and its formula is CH3OH. Okay, methanol is a liquid fuel. This conversion is done in a process called gasification. It's a very, very simple process. It was invented in the 19th century. You don't need a very large refinery to do it. You can do it in multiple scales, and you can have gasifiers that are as small as that they can produce, a few tens of gallons a day, all the way up to gigantic ones that produce millions of gallons or many thousands of tons a year. The methanol, by the way, is the most traded, the most used liquid commodity that is not a fuel, because it is a precursor for many of the things we use throughout, like plastics. It is a solvent. We use it in paints. We use it in windshield wiper fluid. We use it in nail polish and many other household items. Okay, maybe a couple more questions. What can the average consumer do to help drive the fuel freedom effort? Oh, that's a great question. Thank you, Jimmy. I mean, right now, the most important thing that you can do is, I would say maybe like three things. Okay, the first thing you need to do is, next time you buy a car, make sure that you demand a car that doesn't run only on gasoline. Okay, whether you drive, you buy a car that also has this plug-in, say the Volt, or you drive a car that is flexible fuel vehicle that can run on ethanol. And maybe right now there is no place to get the ethanol, but your car will be ready that when this revolution happens, you will be able to obtain this new fuel. You will be able to run your car with this new fuel with minimal modifications. Okay, and also by actively asking the dealers, hey, can this car run on fuels not made from petroleum? We create a conversation in the nation that will eventually get the car companies to change their car making habits. And so if the dealer says, hey, everybody here wants to buy cars that don't run on petroleum, then the car companies will build cars that don't run on petroleum. So that's the first thing. The second thing is you have to stick with us because we are now in the process. The process is going to take some time. Okay, and hopefully what happens is as we roll our program forward, we'll be able to, you'll start seeing probably, and it's very hard to know when, soon, demonstration projects in different areas for our program. Okay, so once this happens, we hope that this will be in your area in the beginning, and then that will be a great way to participate. Okay, last questions. Won't the oil interest take steps to stop production? No, I already answered that question. What the companies are poised to do on the front end of the profit to change over take place towards non-petroleum fuel? What companies are poised on the front end of the profit? So the question is one of investment opportunity. Okay, so first of all, there's a fantastic question. I believe that there's going to be incredible amount of investment opportunities in that space. And the reason is, if you look at the demand for mobility around the world, this demand is rising, but it cannot rise because the price of fuel is kind of keeping a cap on it. But once we introduce lower cost, cleaner, better burning fuels, then this will enable transition to new generation of engines with higher efficiency. And all of that stuff, what it would mean is more transportation availability for lower income people. As a result, we are going to get much bigger demand for these replacement fuels than we even see today for oil. So the question is, who are the companies that are in the forefront of that effort? Today, the biggest producers of methanol are Methanex and Celanese. But we've just heard, last week, Vallejo announcing a $400 million investment in methanol production plant. I think that what's going to happen, most of the people that have today refineries, they will realize that the oil refining business is going to be in trouble when these replacement fuels come in, and they will migrate to produce those fuels instead. That's my guess. I don't know yet who will be the big winners. Okay, thank you very much for joining us today. I do want to remind you that our next session our next webinar in this series is going to take place on Wednesday, October 2nd at 11 p.m. Pacific Daylight Time. I'm sorry? 11 a.m. You're right, sorry. 11 a.m. Pacific Daylight Time. And what we are going to explore next time is the myth that America is going to become energy independent by 2020. And that's it. I hope to see you guys there. Thank you very much for joining us.